So hopefully the previous video was informative and allow you to look at day of the week analysis, or what I call intra-week analysis, to try to see if there's certain effects that you can test to see if there's an edge. One thing I want to really emphasize is that first you need to find an edge before you start applying filters. A lot of people in the algo trading space, where they fail is they try to force an effect onto the market by trying to combine indicators and filters to see if they can create a profitable strategy, rather than first seeing, is there an effect in the market that already exists, and then can I add filters to make that a strategy that I can trade. So what we can do, if we want to take what I showed in the previous video, or rather the entire bonus series here, and apply it down to an even smaller granular level, is we can look at intraday. So we have a tool for identifying hourly biases, and I'm going to show you how I use that tool on the gold futures to develop a short strategy. So here we have the 60-minute chart of gold. This is an in-sample period that I've set from 2010 to 2019. I chose 2010 because the gold futures, they became electronic in 2008. And so the years of 2008 to 2009 exhibited a behavior that is unlikely to be replicated in the gold market. And so I think 2010 is a safe period to start from. And then we've applied the hourly bias finder. This shows the cumulative average of every single bar. So if you bought from 7 p.m. and then sold every 8 p.m. bar, in general, you'd make a little bit of money on average. And then to take that effect in the opposite direction, if you were to buy every 9 a.m. bar and then sell on the close of every 10 a.m. bar, in general, you would lose money. You'd make a sharp decrease in your net income. And so that's the best way to interpret this, is it allows you to see hours where there's typically a lot of volatility and a lot of price movement, and give you ideas for where you may want to limit your entries. And so avoid any sort of flat period here, and try to focus on the sharpest movements. So I'll just say that in terms of the short side, you can technically short from 2 a.m. all the way down to 10 a.m. But the sharpest drop is going to be from 9 a.m. to 10 a.m. There's also a pretty sharp drop from 11 p.m. to midnight. So that's something to keep in mind. And then similar to what we did in the previous video, we're now going to look at recency. So now I have a chart of the 60-minute gold futures from 2020 to 2024. And we're looking at the same hourly bias finder. So now we see that the drop is even sharper from 11 p.m. to midnight. And then some other parts have flattened out. So the effect seems to have disappeared to some degree, or at least has shifted a little bit. But the period from 9 a.m. to 10 a.m. is still a sharp bearish drop. And so what we're going to do is we're first going to see if we have an edge. And the way to do that is to just make a basic strategy where all you do is you you sell short at 9 a.m. and then you buy to cover at 10. And then you go into TradeStation, and then you can go down to a more granular chart. I'd like to use the 5-minute, and you apply that strategy. So that's what we've done here. We just blindly short at 9 a.m. and we cover at 10. If we look at the performance report, what you'll see is that we are technically profitable, and it's barely profitable. So you have a profit factor of 1.14, which means you're barely making money. You can't trade this strategy because it's so low. If you look at the equity chart, you have a lot of ups and downs. That's what all the jagged lines are. And you have massive drawdowns, like 25,000 to 15,000 is about a $10,000 drawdown. I don't think you could trade this strategy. It's arguably not a strategy. But again, the point is to just check if you have a profit factor above 1, because that answers the question, do I have an edge? Is this an effect that is real? Is there an edge in this effect? Again, where a lot of algo traders go wrong is they like to apply filters and indicators and try to create an effect in the market that isn't actually there. You need to actually first prove that that effect exists and that it has an edge. And so using a dummy strategy and then just seeing does it have a profit factor above 1 is a way to do that. And usually if there is a edge there, it's not going to be very strong with just those basic rules that you came up with just to test that effect. So now this is where I typically use a data mining tool. So early in this bonus video series, I mentioned that I like to use Strategy Quant X. I also like to use Build Alpha. I'm not going to go into the pros and cons of different data mining tools, but it's important to, in my opinion, have some options and then to know the pros and cons of the tool that you're using, where its weaknesses are and where its strengths. In this case, I used Build Alpha to mine for different strategies by combining different filters and indicators with the rule that I supplied it, which was that you can only short between 9 a.m. and 10 a.m. And that's just because, again, I'm not having the data mining tool try to create an edge or manufacture an edge just by combining a bunch of indicators and then showing what would have worked historically. I'm saying, look, I already know I have an edge by limiting, entries within this time period. What I need you to do is to try different filters, try different rules, try different indicators to improve this edge so that it turns into something that I can actually trade. That's the best way to use data mining tools. Either that or to identify any sort of seasonality effects. But in this case, for intraday, you need to already be supplying the tool with an edge and then having it improve that edge. And so that's what we've done. I've had to come up with a strategy with some filters, and then now what I have here is a 5-minute chart of gold, and then it's from 2010 to 2019. So this is our in sample period, and I've applied the strategy, and I've made sure that we have some granularity. So the first thing is really high commissions. If you're trading this in personal account, if you're trading gold personal account, your commissions are probably closer to $2. If you're using a prop firm, you pay some pretty high commissions. And then we have limit order take profits, which means that we need look in sidebar backtesting on so that we can verify that the limit order price is somewhat accurate. And then what I've done, I didn't apply a position slippage dollar amount, I applied it here. So our entry in this strategy is a market order, not a limit order or stop order. And in gold, there are 10 ticks per point, and I've assumed 3 ticks of slippage, which arguably is a lot. I think the actual average is closer to 2 ticks, but just to be safe, I've applied 3. And then, of course, we've set the setting here so that we only assume a limit order has been filled when the limit price has been exceeded. So let's look at the performance report between 2010 to 2019. Again, this is our in sample, and we see we have a profit factor of 1.82. So these rules appear to work, and it looks like we would have some drawdowns. And again, this is something where I might want to consider only trading it with some number of micros. The MGC or micro gold is actually quite liquid, and so that's part of the reason to trade gold when as a metal. Just because gold is the most liquid metals market. And if we look at the trades list, again, I mentioned that the rules were we have to exit by the end of the day, or rather this is intraday, so we have to exit at the end of the day. But as you can expect, our most profitable period is going to be between 9 a.m. and 10 a.m. The strategy is limited to only taking entries between 9 a.m. and 10 a.m., but I didn't require it to exit at 10 a.m. because if it can come up with a better exit condition, then maybe it's worth holding a little bit past 10 a.m. But you'll see that most of the exits are either at or around 10 a.m. There's some around 11, but most of them exit before noon. And so you'll see that the end of day exit condition in many cases is not even needed. So that confirms the in sample. And now we go to the out of sample. There's 2 ways you can do this. The first is you can create an out of sample from 2020 to 2024, since that was the out of sample for looking at the hourly bias. Another one is you can just look at it from 2020 up to today. I decided to look at it from 2020 up to today, just to see how it would have performed this year. Most important thing, of course, is that we didn't change the strategy or the strategy rules. So again, we're just taking that same strategy and we're applying it to this chart. Same commission. Look in sidebar, backtesting on because we have limit order take profits. We only fill that limit order take profit if we exceed the trade price and we've got 3 ticks of slippage. So then let's look at the performance from 2020 to today. Looks like the effect, or rather the strategy, got even better. We gained a whole profit factor up. And then the performance graph looks like we actually start the period of 2020 with a drawdown. So we look at the trades list. Yeah, it looks like we hit our stop loss on the very first trade. We're down 1,500, which, by the way, if you ever develop a strategy on gold and you're using fixed dollar amount stop losses, I have found that 1,500 is a pretty good amount, at least for the gold futures. So it looks like we start with a drawdown, but then the rest of the strategy still seems to perform the same, where we're entering between 9 a.m. and 10 a.m. obviously, but our exits are still around between like 10 a.m. to even as far as noon, but most of them seem to be around 10 a.m. or somewhere around 11. And then if we look at this year specifically, we only had 2 trades, and they were in May, and they were both profitable. Would have made about $1,000 this year, which it may not seem like this strategy trades very often, but if you've been watching this series, then you know that what we're trying to do is not create a single strategy that trades very frequently, but rather create multiple strategies that capture different effects, different edges, and are basically the master of capturing that effect. And then we combine them to create a diversified portfolio trading a single instrument. The next step beyond that, if you decide to complete the series and then take the ideas and apply it to a different instrument or even intraday, you're going to want to create the same thing, which is a diversified portfolio of strategies that trade on that instrument. And then ultimately you have a diversified portfolio that trades multiple instruments and then multiple strategies on each of those instruments. And that will lead you into Monte Carlo and correlation analysis. I won't talk too much about correlation analysis in this series, but I will talk about Monte Carlo soon. And ultimately that's the goal, is you have these strategies that are just masters at what they're trying to do. And so you're able to exploit multiple effects to your benefit. So that summarizes the bonus series here. Some of it may not make sense if you are still pretty fresh, if this series has been your intro to algorithmic trading. But hopefully at the end of this series, after you've developed some more experience and looked at the strategies that I have taught and thought about the things that have been taught in the series, and then you decide, what, I want to dive into intraday, then you can come back to this set of bonus videos and then try to take the approach shown here. But again, this is just a bonus series for those of you who want to see what I'm doing nowadays, how I develop strategies on intraday, on intra-week, even intra-month. And so, hopefully this has been helpful to you guys. And after this, we're just going to go back to the regular programming of showing daily charts on SPY and more ideas, more effects, and more ways to try to codify those effects and then see if we can add filters to turn it into a tradable strategy if it has an edge.